What's good, family? So today we're going to talk about the balance sheet, another critical component when looking at a business. Now, I don't care if you're a trader, I don't care if you're a long-term investor, you should study the fundamentals of a business. One of the reasons why I've been so successful when it comes to investing and trading, which y'all know we probably one of the only people in the game that show our portfolio every week on the show Trapping Tuesdays. We've literally beat the market 3 years in a row by double digits. Like in 2022 when the market was down, we still had a 17% return. Last year we had a 33% return, and this year we had a 45% rate of return, right? So it's not competing with nobody else, it's just double-digit returns in my buy and hold, but that's not even counting what we're doing in the options market, which we put that portfolio here too once a month, but we also show it every week on Trapping Tuesdays. It's 7 p.m. every Tuesday on the Wallstreet Looks Like Us Now network, and it's live, right? And so for me, I am heavy into studying the fundamentals of a company because the fundamentals of a company show me like the money, the financial strength of a company, the financial weakness of a company, how money is coming in, how money is going out, what they investing in, what they're using the money for, are they paying down debt, how they paying dividends, are the dividends at risk? All of these things. Now, what happens with people like you and me, when we new to the game, we think we got to be an accountant to understand all this. And so in the Wall Street Trapping course, I'm not trying to sell it to you now, but in the Wall Street Trapping course, one of the things I do is show you specifically just, you need to look at this, 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 and this. So what I'm gonna do today is, now we already did the income statement. Now we're gonna break down the balance sheet. Now this one tells you about the assets and the liabilities that the company have, which is important, but also we're gonna get into retained earnings. We're gonna talk about working capital. We're gonna talk about some of these other things so you can understand that financial strength. We're gonna talk about book value, right? These are some of the things that is critical for you to understand as an investor. So before we get into that, man, I want you to like, I want you to subscribe, right? I want you to look in the comments and tell us how can we help you. But also, like, if you see somebody like trying to like manipulate people, you know it ain't me. They're telling you, DM me for this. I'm not gonna tell nobody on YouTube, DM me nothing. My only page on Instagram is Wallstreet Trap. I got 1.5 million followers, got the blue check, so I don't got none of them other pages. Like, block them people, man, because they out here scamming people, and that's not cool, man. So let's get into it. Once you like, once you subscribe, you better get your pen in your pad, because we about to get into it. So first we're gonna write it out what we talking about. Now, the reason why this is important for the balance sheet, so I wrote something down. I always write notes. I don't be trying to freeze. I be trying to write notes so I can know specifically what I want y'all to know. So watch this. This shows us the funds flows in and out of the company during the time span of 1 year, but it's looking at it from an asset perspective, like the assets that the company owns. It also is going to break down to us, watch, it's going to show us not only the assets, but it's going to define how financially strong a company is, right? We're going to define right now how financially strong a company is, right? And we're going to get a comparison of the assets that the company owns and the liabilities that the company owes. The difference between the two is going to give us what's called the, watch this, book value. And the book value of the company can be also known as the, watch this, the net worth of a company. Why? Because you're subtracting liabilities from assets, just like you as a person. You want to know your net worth? What do you got to do? You got to subtract your liabilities from your assets, right? And so that's two things that we're going to look at right there when looking at a company, right? So another thing I want to go to, and I wrote this down for y'all, right? This is going to show us, watch this, which portion of the assets are financed by debt. So watch this, assets that have, we're gonna write this down, dilution, right? And why do you say the word dilution? Because if the asset is funded by debt, it's not the full asset unless it's all the way paid off. So think about your house, right? You don't get the full propensity of the asset until it's paid off. So what I mean by that is, like, think about your house, right? Think about owning a house, right? Well, yes, you are a homeowner, but it's not your home until you own the whole home, right? So you're in a process of paying down the home until it's all the way yours. Until then, it's for the bank, right? And even then, you still got to pay taxes on it, right? So you want Because as long as the asset, now here's the thing, the asset can be cash flowing, which is good. But watch this. When the asset is cash flowing, some of the cash flow still has to go to the debt that is used to fund it. So now it goes two ways. Right? So that's going to be important. But then it's going to show us, watch this, it shows us also the portion of equity that the company has. So the equity comes out in its form of, watch this, I'm about to right here, y'all. Watch what I'm about to right here. All right, so when we talk about a company having retained earnings, right? Now this is key. I want us to understand this right here. This is key. So two things we just talked about that's going to be important. We talked about the book value, which is the net worth of a company, which talks about the assets minus the liabilities. Now, when we get here, I'm going to write this on the board so we can understand it. Let me write it down for you. We're going to write it again. Retained earnings. All right, so I washed it down for you. It is the profit. It is what the company has left. Profit that the company has left. Watch this. After they pay all direct costs, after they pay all indirect costs, after they pay all income taxes and dividends. Now, in the other video, I told you two things. I said that dividends are what's called outflow, but also I told you in the other video, in the income statement, the net profit of a business doesn't include the dividends. Now, the retained earnings includes the dividends. You feel me? Now we're going to have another number we're going to go to that we're going to talk about. Right? We're going to have another number we're going to go to. Now watch this. These retained earnings are used for a few things. They're used to buy more equipment. They're used for research and development. They can be used for marketing and branding. So these retained earnings are important because after dividends come out, after direct costs, after indirect costs, after income tax, after dividends come out, this money, that's why I don't say it can be used for dividends. This money can be used to do what? Buy equipment, research and development, marketing and branding. Also, there's another thing on here called working capital. We talk about this deep in the Wall Street trapping course. This is current liabilities. This is current assets minus current liabilities. Now that tells us the current, and I want you to look at that on the Wall Street trapping course. It talks about why this is so important. It talks about why the working capital. We break that down in the Wall Street trapping course on why that is so important and what the numbers we look for when it comes to working capital. So when we're looking at this balance sheet, right? This balance sheet shows us the balance of a business financially. And the reason why we call it a balance sheet is because it balances everything from assets, liabilities, and owner equity. Now, Trap, that's a new one you just said. Owner equity. Why is that one so important? And I'm going to tell you why. Because when it comes to owner equity, watch this. This tells us who gets responsibility of the company's assets in case the company has a problem. So if the company have a problem, it's talking about common shares, it's talking about retained earnings, it's talking about money coming in. Who gets access to that based on if the company have a problem? So also, we're going to look at that. We're looking at assets, we're looking at liabilities, we're looking at retained earnings, we're looking at owner equity, and we're looking at book value, which is the net worth of a company. This is why the balance sheet is, to me, the most important I want you to understand that these three, again, we go super in depth on the Wall Street trapping course, like really in depth on why you need to look at it and how you break it down, how you see it, what you need to look at. But this is important for you, man. So look, let me know in the chat how you like the video, man. We love y'all. We appreciate y'all. Make sure you check out our show each and every Tuesday. It's called Trapping Tuesdays. It's on the Wall Street Looks Like Us Now network on YouTube. Also, we have so many snippets that's on all podcast platforms. We would love for you to check that out, man. It's your boy, the Wall Street Trapper, man. I love y'all. I appreciate y'all. Y'all know our goal is to help the culture build well, one share at a time. Salute.